Right now, billions of dollars are changing hands on global financial markets. Some people are getting richer. Some are watching their savings shrink. The vast majority of Americans are completely on the sidelines, not because they cannot invest, but because nobody ever explained how this actually works. That changes today. Welcome to the Algorithm Investor, the channel built for people who are done being left out of the conversation. Whether you have $50 to invest or $50,000, whether you have never bought a stock or you have been investing for years, this channel meets you exactly where you are. Every single week we break down one concept clearly, honestly, and without the jargon. No fluff, no filler, just the information that actually matters for building real wealth. Today is week 1, and we are starting with the most important question in personal finance. What is the stock market, and why should every single person care about it? Imagine your friend Maya starts a juice bar. Business is going well. She wants to open a second location but needs $50,000 to make it happen. She has 2 options. She could go to the bank and take out a loan, or she could go to 10 of her friends and offer them a deal. She says, "Give me $5,000 each. In return, you each own 10% of my business. If this juice bar makes money, you make money. If it grows, your piece grows with it." Each friend now owns a share of Maya's business. That piece of ownership is exactly what a stock is. Not a number on a screen. Actual ownership in a real business. Now scale that up. Instead of a juice bar, imagine Apple, one of the most valuable companies in human history. Apple is publicly traded. Publicly traded means anyone can buy a piece of it. You, me, a 19-year-old with $10 and a brokerage app. The barrier to entry is lower than most people realize. The stock market is simply the place where those pieces get bought and sold. Think of it like a massive, highly organized marketplace. Except instead of furniture or produce, what is being traded is ownership in companies. Real businesses with real employees, real products, and real profits. The New York Stock Exchange and the Nasdaq are the 2 biggest stock markets in the world. Together, they are home to over 6,000 companies. On any given trading day, hundreds of billions of dollars worth of shares change hands. It is the largest wealth-building mechanism ever created, and it is open to everyone. Most people think keeping money in a savings account is the safe and responsible choice. And I completely understand that instinct. It feels secure. It feels cautious. But here is the reality that most people are never taught. Inflation averages about 3% per year. That means the cost of everything around you rises by 3% every single year. So $10,000 sitting in a low-interest savings account today has the purchasing power of just $7,400 in 10 years. You did not spend a dime, but you got poorer. Not investing is not the cautious choice. Not investing is the risk. Sitting on the sidelines has a very real cost. Most people just never see it on a statement. The stock market has returned about 10% per year on average over the past century. Through wars, recessions, crashes, and crises. 10% per year on average. That is the single most important number in personal finance. 10%. Write it down. Put it somewhere you will see it every day. Here is what 10% per year actually means for your life. Say you are 25 years old. You put $10,000 into a simple index fund and you never touch it. You do not check it every day. You do not panic when the market drops. You simply leave it alone and let time do the work. By age 35, you have $25,937. By age 45, you have $67,275. By age 55, you have $174,494. And by age 65, you have $452,593 from a single $10,000 investment, made once, at age 25, and never added to again. That is the power of compound growth over time. Now here is where most people make the critical mistake. What if you waited just 10 years, until age 35, to invest that same $10,000? By age 65, you would have $174,494. Same money, same market, same 10% return. But waiting just 10 years to start cost you $278,000. That is not a small difference. That is a life-changing difference. And it happened simply because of when you started, not how much you invested. That is the brutal math of compounding. It does not care about your income. It does not care about your job title. The only variable it punishes you for is waiting. The best time to invest was yesterday. The second best time is today. And that is exactly why this channel exists. So how do stock prices actually move day to day? Every share has a price determined entirely by supply and demand. Nothing more complicated than that. If more people want to buy a company's stock than sell it, the price goes up. If more people want to sell than buy, the price goes down. Supply and demand. Every time. Here is something that surprises most people. Professional fund managers with research teams, Bloomberg terminals, and decades of experience fail to beat the market average more than 90% of the time over 20 years. 90% of professionals cannot consistently beat the market. So trying to pick winning stocks yourself every day? It is a losing game, even for the pros. So what is the smarter approach? Instead of picking individual companies, what if you just owned all of them at once? That is exactly what an index fund does. An index fund is a single investment that automatically holds hundreds or even thousands of companies simultaneously. The most popular one, the S&P 500 Index Fund, holds the 500 largest companies in America. Apple, Microsoft, Amazon, Google, Johnson & Johnson, all of them. One purchase. And the fees are almost nothing. We are talking 0.03% per year. That is 3 cents for every $100 you invest annually. Remarkably cheap for what you get. Warren Buffett, arguably the greatest investor who ever lived, has publicly said that when he dies he wants 90% of his estate in an S&P 500 index fund. Not individual stocks. Not actively managed hedge funds. A simple low-cost index fund. If that approach is good enough for Warren Buffett, it is worth paying attention to. Now, before we wrap up, there is one more thing you absolutely need to understand. And this is the thing that will protect you more than any stock tip or strategy ever could. The market will crash. I do not know when. Nobody does. But it will happen. It has always happened. And it will happen again. 2008. The market dropped 57%. 2020. It dropped 34% in just 33 days. Those numbers are frightening when you are living through them. But here is what the history books show every single time. Both crashes recovered completely. Both went on to reach brand new all-time highs shortly after. The investors who got financially destroyed were not the ones who stayed invested. They were the ones who panicked, sold at the bottom, and missed the recovery entirely. Warren Buffett said it best. The stock market is a device for transferring money from the impatient to the patient. Be patient. That is your single greatest edge as an investor. So let us recap what we covered today. The stock market is simply a marketplace for buying and selling ownership in companies. Anyone can participate. Not investing has a real cost. Inflation silently erodes the value of cash every single year. The stock market has returned 10% per year on average over a century. Starting early matters enormously. Waiting just 10 years can cost you hundreds of thousands of dollars in lost compound growth. Index funds give you instant ownership of hundreds of companies at almost zero cost. And patience is the single most powerful tool any investor has. Next week on The Algorithm Investor, Week 2. I am walking you through opening your very first brokerage account. Step by step. On screen. In under 10 minutes. No prior experience required. No financial background needed. Just a phone or a computer and 10 minutes of your time. That is it. Hit subscribe and turn on the bell notification so you do not miss it. This channel is completely free, and it always will be. Before you go, drop one comment below. Have you ever invested in the stock market before? Just yes or no. I read every single comment. See you next week.